So if you look at the screen, you would see I've just copy pasted the relevant issues from the scenario on my answer script. This is my answer script basically. So what I did, I just copy pasted the relevant issue. For example, we talked about new product lines in the early development stages. I've just mentioned that there was a new manufacturing line with a 5-year maintenance plan. I've just copy pasted that. It talked about the loan from bank, 8 installments, interest. I wrote about that. Stock exchange listing, the company's intention to get a stock exchange listing. I've just copy pasted that. The company offered extended credit terms. I just mentioned that. Then over here, I also linked it with the ratios. And that's for a reason. Because credit terms have a lot to do with your receivable days. Your receivable days are basically determined by the credit terms that you offer. So there's a correlation. So I said that, okay, fine. Whatever extended credit terms, I'll try to link it with the relevant ratio, and receivable days would be a relevant ratio over here to talk about. Then I saw about price promise. I just mentioned it. I got to know that there are faulty paints that are being returned, that might be there in the inventory too. So I've just copy pasted them. And for inventory, because I have a ratio with the title inventory days, I would be able to link it over here with the ratios. Then I copy pasted going concern troubles linked with ratios. You calculated payable days, you calculated current ratio, you calculated the acid test ratio. And if we just quickly look at those ratios, you would see all of them depict a negative trend. Payable days have increased. Current ratio, payable days have increased, which means a worsening trend. Current ratio has decreased from 3.08 to 1.65. Quick ratio has reduced from 1.97 to 0.99. So all of these are depressing signs. All of these are signs of troubles. So they indicate that company may find going concern problems, going concern issues, may find it difficult to continue in operational existence, right? So I hope you're happy with the identification of issues. We've just identified them. We haven't answered the question yet, but I hope you're clear on the identification part of it. So now that you've identified the relevant audit risks, you need to have an appropriate examination technique in describing or in answering your audit risk question. So here you go with the exam technique. The exam technique to answer audit risk questions is very simple, is very easy. Let me take you through the exam technique, and then we would apply it to all these 9 points. Number 1, identify the relevant issue. Identifying relevant issue means just copy paste from scenario. Whatever relevant issue you see in the scenario, just copy paste it on your answer script. Over. Number 2, state the relevant accounting rules. Where possible, you need to spell out the relevant accounting rules, the requirements of the applicable accounting standard pertaining to that particular issue. And having stated the relevant accounting rules, talk about what could go wrong in the financial statements. Where could the financial statements go wrong? Which components of the financial statement could be overstated? Which components of the financial statements could be understated? What sort of disclosures could be missed out, could be omitted? What disclosures could be inadequate? So when you talk about this, your answer to this question is done. So let me teach you in a more precise manner how you would go about it. Let's apply this exam technique. The first step, we've already done that. We've already identified all the relevant issues from the case study scenario. Now we would go on to move on to the step 2 and step 3. So for the first scenario, for the first thing, developing new product lines. New product lines at the early stages. So what are the relevant accounting rules? IAS 38. What does IAS 38 says? IAS 38 says research expenditure, it's to be expensed out. Development expenditure, if it meets the criteria, if it meets the criteria, then you can capitalize it. This is the relevant requirement. Now, what is the So we've performed step 1, we performed step 2. Now step 3, what could go wrong in the financial statements? That is, what component could be overstated, what component could be understated. The issue could be, for example, research expense could be overstated, OS is overstated, development expenditure, research expenditure understated, because instead of treating it as a research expenditure, you treated it as a development expenditure. So development expense could be overstated and research expense understated. It was a research cost and you capitalized it. So you've overstated your development expenditure and you've understated your research expense. Similarly, for the second point, so this is the first point that you've identified. So you identified the point, you stated the relevant accounting rules, and you went on to describe what could go wrong in the financial statements. Now let's talk about the second point. New manufacturing line with a 5-year maintenance plan, 5-year servicing and maintenance plan. Now what are the relevant requirements? IS 16. What does IS 16 says? IS 16 talks about it says that you don't have to capitalize your maintenance costs. No, you don't have to capitalize your maintenance costs, right? That's what the IS 16 says. Now, because it's a 5-year servicing and maintenance plan, you would have to depreciate this. You would have to depreciate this cost of $0.5 million over 5-year period rather than over the useful life of the asset. This is the accounting requirement. Now, what could go wrong in the financial statements? That you capitalize the maintenance cost as part of the asset and depreciate it over the useful life of the asset. So what would happen? Your depreciation expense is understated and your assets resultantly, or your PP, would be overstated. So you see, again, we've applied all the 3 steps. Then loan from bank. Third issue that we've identified is loan from bank, 8 installments, interest. So the popular risks that could be there, you have, for example, what are the accounting rules? You have to segregate between current, non-current liability, right? You have to, what are the accounting rules? You have to accrue your finance cost. What other rules exist? For example, you would have to, disclose assets provided as security. These are the accounting rules that pertain to this particular issue. So over here, we've stated the rules that the loan from the bank, because it has 8 equal installments, it has to be repaid in installments over 8 years. So it would have portions of current liability, non-current liability. It will have certain finance costs associated with it that would have to be accrued. Moreover, you would also have to disclose the assets which have been provided as security in order to obtain this loan. Now, what are the risks? There could be financial statements go wrong. Disclosures could be an issue. That is the loan not correctly classified between current and non-current liability, right? Finance cost and accrual, and its accrual could be understated. You did not recognize finance cost correctly, you did not record its accrual. There could be inadequate disclosures. Of assets provided as a security. These are all the issues that could be there in the financial statements. Let's move on to the fourth risk. Intention to get a stock exchange listing. Now, this is actually a fraud risk factor. Remember, there's a fraud risk factor. Why? Because if a company, there's no, now in this particular scenario, this is a ROM at what level? At the FS level, at the financial statement level. Why? Because they're in the process of getting, or they have the intention to get their company listed on the stock exchange. So they would, when they would offer their shares to the public, the better the financial position of the reflected from the financial statements, the better price they would be able to fetch. So this represents ROM at FS level. There could be material misstatement anywhere in the financial statements because management might be under pressure to present a rosy picture, a nice picture of the company's affairs to the potential shareholders to get a nice price. So they could manipulate financial statements anywhere. So in this case, you cannot, you're just answering this, state the relevant accounting rules. There's no specific one rule over here. What could go wrong in the financial statements? There could be material misstatements anywhere in the financial statements because the management would want to paint a nice rosy picture of the financial statements. Extended credit terms. The company has offered extended credit terms. So let's talk about those extended credit terms. There could be, state the relevant accounting rules. Now the relevant accounting rules over here is bad debts, due to extended, bad debts not recorded, right? There could be bad debts because of it. Then you also need to establish the link with the, over here you have to link with the receivable days. So receivable days, from the computations that we perform, receivable days have also increased. So that could also be a troubling indicator. And what is the risk? That your bad debts are, say, understated and your receivables are overstated. This could be an issue. Price promise. Price promise is another issue that you need to take care of. The price promise means that you would have to, with the price promise, what is the issue? That you would have to carry a refund liability all the times. And a refund, if you're carrying a refund liability is computation, is judgmental, prone to error, right? There could be issues in revenue recognition as per IFRS 15. So if that's the case, then maybe your revenue is overstated, your refund liabilities are maybe understated. Faulty paints in inventory. Also need to talk about there is a fault in the paints, so there must be certain paints which are lying in the inventory and they may not be rectified because they're still checking on if they can be rectified and subsequently sold. So what is the relevant accounting rule? IS2. What is the relevant accounting rule? That is IS2, inventories. Measurement or inventories valuation at what? At lower of cost price and NRV. Inventory valuation has to happen at the lower of cost and net realizable value. What is the risk? Where could the financial statements go wrong? The risk is that inventory may be overstated. inventory may be overstated and cost of sales may be understated. The return of faulty paints. The return of faulty paints. Faulty paints, when they'll be returned, there could be risk. What is the accounting rule that sales returns not to be included in revenue, right? And even this includes sales returns not just before but also after the year end. Even if there are returns after the year end pertaining to this paint, that would be treated as an adjusting event, because you already know the condition of faulty paints exists at the reporting date as well. So what is the risk? The risk is that your revenue is overstated and your sales returns understated. Then the going concern troubles. Your bad position, bad or rather adverse liquidity and solvency position is indicated by payable days, say quick and current ratio. So what is the, and so because these are indicators of going concern troubles. And what does accounting rules require? The second step is to state the accounting rules. So the accounting rules require you to disclose material uncertainties. That's what IS1 requires, that the management should disclose material uncertainties. Now, what is the risk? Risk that material uncertainties pertaining to going concern not adequately disclosed in the financial statements. So we've talked about the risks that could be there. So that's how you answer your question on audit risks, that you talk about the relevant issue. You just copy paste the relevant issue from the scenario, then you go on to expand on the relevant accounting rule in most cases, and then you tell what could go wrong in the financial statements. That could be where the risk of overstatement or understatement exists, or where disclosures could be missing or inadequate.